Kenanga Investment Bank forecasts the country's economic growth to moderate to 5.1% in 2015 from an estimated 5.8% in 2014. Head of Research Chan Ken Yew says this is amid the impending goods and services tax implementation and a generally weak global economy. He says the main contributors underpinning the growth this year would be exports demand, especially from the US and the construction sector. Nonetheless, Chan cautions that the ringgit is still under pressure amid stronger US dollar and low oil prices.
Let's say proven to stay below, say 50, then obviously we have to revise. But at this juncture, I can only say the pressure is there, but it much depends on the oil price moving forward.
Speaking during an economic outlook briefing session, Chan also warns that the local equity market will remain choppy and volatile moving into the first quarter of the year. Kenanga is targeting the FBM KLCI to be pegged at 1,905 points by the end of the year, implying 17.7 times FY16 price-earnings ratio on the back of 1.3%, 4.7%, 7.4% earnings growth for the years 2014 to 2016. Chan says it is likely that the research house will lower the price-earnings ratio by 1 time to 16.5 times with the index target of 1,860 points by the end of the year, depending on the market performance and the earnings growth in the first half of the year. Despite the foreign outflow totaling to 7 billion ringgit last year, he notes that it is still at a manageable level, given that the total outflows is less than 3% of the entire foreign holding in the local equity market. As a result, he opines that there is no need for Bank Negara to raise interest rates to curb the foreign outflows at the moment. Meanwhile, Chan notes that the additional revenues from the upcoming goods and services tax would cushion the slashed oil revenues and help the government fiscal position.
Based on our rough estimate and based on the economic report, it looks like we will see about 8.5 billion additional revenue coming from our GSC, and that, based on our estimate, should be accounted for about close to 14% of the, I would say, the oil revenue.
For short and medium-term investment strategy, Chan suggests bottom fishing heavily sold down stocks, GSC beneficiaries, export-oriented sectors such as electrical and electronics players, original equipment manufacturers, and glove makers. He adds that resilient sectors such as telco, sin, wheat, power, pharmaceutical, and consumer staple food sectors are in focus as well. Charlotte Chong, The Edge TV.